Are you new to trading and you're trying to figure out why everyone's chart has all these amazing colorful lines on them? Well, I'm going to help you out. I'm going to show you how I made $14,000 in just 4 days by simply charting supply and demand zones. Let's get into the video. Let's talk about what supply and demand zones are. Supply is pretty simple. You're very familiar with this term. You just may not know it's called supply. It's basically a predicted area on a given asset in which we expect there to be more sellers than buyers. What does that mean for us though? Let's look at a real life example, okay? When you have companies that have an excess of supply, what do? They sell. Or they give it to TJ Maxx, but that's just a whole nother story. Stocks act in a very similar manner. When there are more people trying to sell than there are to buy, we expect the stock price to go down because these sellers are trying to get the product or asset out of their hands. The main reason why they're doing this is because either they've taken a lot of gains or they made a bad trade and they're trying to get out to buy at a lower price. So when you see a surplus in selling, that means one or two things. Most people are just trying to take their gains. It doesn't necessarily mean that the company is bad. It just means that people have made a really good profit or they made a really bad trade and they're trying to sell. The word supply is also interchangeable with the word resistance. You'll hear a lot of people use the word resistance lines, and that normally means that a chart looks like they're going to experience some pretty heavy selling at a particular point of resistance. So then demand zones are just really the opposite, right? Demand is really when you just have more buyers than you have sellers. Think about it like this. You can normally find a bottle of Lysol for about $2 to $3, give or take, right? Depending on where you are. If you're in New York, maybe a little bit more than that. But because the COVID-19 virus has recently hit us in 2020, Lysol has become a hot commodity. There have been more buyers of Lysol because of its ability to fight the virus than there have been of sellers. Mainly the sellers are the major industries like the CVS's, the Walmarts, the Walgreens, and your grocery store. There are more people buying Lysol than these stores have supply of. So they have created a demand zone for Lysol. Now these people went to CVS, Walgreens, and thus stores and purchased all of the Lysol, creating a demand, meaning that there aren't many sellers of this particular product. So then they can then repackage the Lysol, maybe put it on Facebook Market or Amazon or on Craigslist and demand more for the product than they actually purchased it for. When you have more buyers than sellers, that means that the product is being purchased and is going to create a demand in which people are willing to spend more money on that given product than they were a few weeks, days, moments ago. The word supply is also interchangeable with the word support. It often is referred to as a support line in which a stock or a ETF or any underlying asset has hit and seen a surplus of buyers. So as you can see, stocks actually act just like your modern day trading. It's no different. We move based off of supply and demand. So what we try to do with these supply and demand zones is predict pretty much when we think the people are going to buy and when people are going to sell. Now, this isn't foolproof because, of course, you can experience a lot of selling in a place in which you thought there were going to be a demand and it may fall through. So today I'm going to teach you how to chart your supply and demand zones. All right, let's get into it. So here we are, we're in Thinkorswim and we're ready to finally chart some supply and demand zones. Now I'm going to walk you through as fast as I possibly can and explain it the best way I can for you guys. What you do with this information is completely up to you. I just want to teach you guys how to do these zones. So we're going to take a look at Apple here, which is one of my favorite charts. So let's go ahead and get into charting out Apple. My advice to you is to wait until around 7 o'clock, 8 o'clock Central, just because that's when post-market closes and you can kind of see the price action in post-market to help you finish your charting for the day. I normally chart for an entire week, and if there's a breakout, I have to then rechart, of course. I normally chart for about a month out, and I'll show you what that looks like here. So I'm in Thinkorswim. You can do this on any trading platform that allows you to chart. I'm going to go out to about 20 or so days. So you'll see I already have some lines down here that are charted, but Apple has broken out within the last few weeks, and I really need to rechart this. So I think this is the best example to do so, okay? But first, let's look at some previous charting to help us understand how I knew Apple was gonna break out at this orange line here. So if we look at this chart, this is basically 5/26/20 to 6/5/20. So about 2 weeks worth of time, okay? You may ask me, well, why do you have all of these different lines on your particular chart? And I'll explain to you what they are. First of all, let's start at the very top. This orange line for me, and I just colored it orange. This is something that I do on all my charts. This orange line represents an all-time high. So if we go back before the pandemic, you'll see here that this is our all-time high, and we actually hit it a few times before we end up falling down to $211 with Apple because of the pandemic. So I have an orange line on all of my charts to tell me where the all-time high is. That's just an indicator that I like to use to know when we're breaking out. And as you see, we did break out after we passed that orange line, and we've held it since. So now let's go back to pre-breakout and how we predicted that breakout. This purple line here represents a weekly average. So what I do here is I find the very high and the very low, and then I average them out, and I find the price target between the very high for the week and the low for the week, and I find that average. That average to me just lets me know where the stock normally trades at. It's not a supply or demand zone, it's just a weekly price average to let me know kind of a standard deviation of where I can expect the price to be throughout the week. Now let's actually chart some supply and demand line. The first thing I'm gonna do in Thinkorswim is come up to my drawing tab and find a price line. So this is a price level. I'm not sure what it looks like in other charts, but it's just pretty much a horizontal line at a particular price. I'm gonna look here and say, okay, where can I find my support for the week? Charts can dip below your price line for resistance. Just because you chart a demand line doesn't mean that that's what's gonna happen once the price hits there. You have to be patient. Often we'll see a demand zone, meaning that there's a level of buying throughout a particular price range. So sometimes you'll see that it does dip below my demand line, but it normally comes back up because people are buying in that particular zone. So let's go ahead and plot a really good demand line. So I'll see that here on this open and close arrow. This is really good volume here, and it takes us all the way from 315 all the way up to about 320. That's a lot of buying, and that's 3 million shares, which is about average for Apple. So this is going to signify heavy buying on this line, and you'll see that it almost hits off a few times here. So I'm going to go ahead and mark this line as a buy zone. So this is going to be my support. So now we've marked our support line for the week, and we can see that it normally hits down here and then bounces back up. We have one down here, it comes down in pre-market again, it comes down in the next day, and it continues to do this kind of triple bottom, which is a very bullish pattern, by the way. Now let's support some lines of resistance. Now that we know where our demand line is, we can find our supply line, which looks like it is about right here. We have marked our supply, meaning that there are a lot of sellers up here. We see that every time we're up here or above this line, we get heavy selling. So if we look at this line here, this is an hour of just selling. We opened up here, we shot up for a little while, but as soon as we shot up, we saw a lot of selling, and it brought us all the way back down to about halfway through our zone. And then what happens after that, we end up bouncing back down to demand, coming back up to that line, and then initially coming back down to demand. And this is how people are charting and making their trades. They're coming down to demand and they're waiting for a price correction, and then they'll buy, and then they come up here and then they sell, okay? This is how you become a better trader. You find these lines, you find these patterns, and then you trade these patterns. But let's continue with marking our chart. So now we have our supply zone and we have our demand zone. So in between our supply and our demand zone, we have about a 3% gain on Apple. You can take it all the way from 315 all the way up to about 323, which looks like a really good trade of 3% every time you make this trade. Now, we're not looking for home runs every time we trade. We're looking for whatever your rules are. My rules say about 3 to 5% is normally what I'm looking at per trade, okay? So this to me is a really good trade because I am making my goal. We have plotted our supply and demand lines here, and we can see that it is following the pattern. So now let's go ahead and read the volume on these supply and demand lines to kind of confirm our assumptions. So if we look at this supply line here on the hour candle at the close of the week, you'll see that it is almost 3 times higher than the normal volume, which sits somewhere around 2.3 million shares traded on a normal average candle. So it did exactly what we expected. It was a heavy sell-off right here at this supply line, double the amount of selling in volume on this particular candle. This is our confirmation that there's a heavy wall here of sellers. And if we come down here to this actual demand, we can see that we're going up at about 3.6 million. So to about 1.5 million more than the average of 2.3 and some change. So you'll see that it does take us up, then heavy selling. This is our confirmation based off of volume that we have mapped and charted our supply and demand zones correctly. Now, once we break our resistance, which is our demand zone, resistance then becomes support. So you have to figure out if resistance was broken strong, with meaning there was a lot of volume, or if resistance was a weak break and they're going to eventually be sellers. What we see here is a pre-market break, but you'll see that we come right back down, and that week we normally didn't get back up past supply. This signifies that there weren't enough buyers up here to keep us inside of this new demand zone. The next week comes, and now we begin the week above the demand zone, and we kind of don't have a ton of volume. You'll see here that we have one candle signifying that some really strong buying, but then we end up coming right back down on another very strong candle and buy here. So this pattern right here is very special to me because it actually signifies that we should be having a breakout fairly soon. You'll see that it looks like consolidation, meaning that the candles are really tight. You have people getting out and people getting in at the same time. So the buying and selling is almost identical, which is why you'll see a chart look something like this, where we're not having major movement like we did the last week. Last week, Apple was swinging from almost 15 to 20 points. This week, Apple was only swinging about 10 points, 5 to 10 points. This is what we call consolidation. Very tight buying and selling, bouncing off of your resistance. It may break, but you'll see it never comes back down to our other demand zone. This is considered consolidation, and it normally what happens before a breakout. You'll see that the next few days we end up breaking out, and the reason why we break out on average volume is because there was so much buying and selling in here. It consolidated, and now everyone has their shares and they're pushing the stock higher. So this signifies that people are finding value in the stock, and you can trade this. It's a little bit dangerous because you're in between zones, but if you predict it right, you can make a lot of money or lose a lot of money. As you can see here, we consolidated here, and then we took off from 323 all the way up to 354, which is about a $30 gain per share. And that is how you read charts and mark your supply and demand zones. I really hope this has been helpful for you guys. We're going to do way more videos on how to use supply and demand zones to execute your trades. And I hope that you guys can use this and take this into your daily trading. Happy trading, guys. Take care. If you have enjoyed this video and you look forward to more trading videos, please make sure you hit that like and subscribe button. It really helps me grow this channel. Here on Breaking Stereos, we plan on doing a lot of trading videos to help diminish that financial knowledge gap that exists in many communities. So your support is greatly appreciated. Thank you for coming by my video. Take care.